Okay, good afternoon and welcome back everyone to our Options Education webinar series. My name is Tony Zhang. I'm the Chief Strategist here at Options Play, and today we're going to be covering a very important topic, the option Greeks. Many of you may find this topic overwhelming or complex. So today what we're going to try to do is break down the option Greeks, why they're important, what you should be aware of when it comes to looking at option Greeks, and how you can utilize it for your trading. So let's go ahead and get started. Now, every single 2 weeks, we do these sessions on Wednesdays at 12 p.m. Eastern, focusing on your options education, empowering you to trade sustainably and confidently. So I hope that many of you that are joining here today will continue to join us on this journey. Hopefully you've been on this journey with us for quite some time already. But if this is your first time joining us for our options education sessions, these sessions are, like I said, held every single Wednesday at 12 p.m. Eastern to help you better understand how to utilize options in your portfolio. I'll leave this disclosure here up on the slide here for 1 minute, but effectively this is a disclosure on the risks that are involved in options, and please make sure you understand them before you utilize options as an asset class in your portfolio. And what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using as example purposes during today's session. So let's talk a little bit about why we should study the Greeks. First of all, there's a few things that you can utilize the Greeks for. Number one is just understanding an options price. Some of you, you think about a stock price, like what goes into the decision-making process between the value of a stock. Well, when you think about the value of an option, they are made up of different components, and the Greeks are part of that understanding of how an option is priced. So that's number one. The second thing is strike selection. When you're trading options, you have to select expiration dates and strike prices. And many times you can use the Greeks to help you to find out what might be the right strike price to choose for various different types of strategies. And the third thing is position management, because once you're in a position, you need to understand how the market is going to affect the value of your option. And that kind of goes back to the first point, option pricing, because when you're looking at the Greeks, that's going to help you understand whether or not, how much exposure you have to a specific factor, and whether or not it makes sense for you to stay in that position, potentially adjust that position, or close that position. So there's many reasons why, if you're trading options, it's important to understand and study the option Greeks. So first one is just options pricing. And we're going to go through this fairly quickly because we'll come back to this at a later stage. But when you think about an options price is made up of two primary components, or two components, intrinsic and extrinsic value. Intrinsic value is simply the difference between the strike price and the current price of the stock, and either something has intrinsic value or it doesn't, right? So it's just how much an option is in the money by, that determines the intrinsic value. And then you have extrinsic value. That's based on how much time is left in the option contract and implied volatility, meaning what is the market's future expected volatility of the underlying stock. The more time there is left, the higher the extrinsic value, the higher the implied volatility, the higher the extrinsic value. And when you combine those two components together, that is what the current options price is comprised of. And we're going to come back to this because when we think about extrinsic value, but time value and implied volatility, you have to understand option Greeks to understand how the time value and implied volatility factors determine the extrinsic value of an option. So the intrinsic value is easy to calculate. The extrinsic value part is the part that we have to look at those external factors, and the Greeks will help us understand that. So what affects an options price? Generally speaking, there are three things that are going to affect an options premium. Number one, whether the stock moves up or down is the number one thing that determines the the internal factors, the intrinsic value of an option. And then you have external factors, meaning how much time is left between now and the expiration date, and the anticipated movement, meaning the implied volatility of the option. Those are the three primary components that determine the value of your option. And we're going to put it into the context today of long calls and long puts to determine whether something makes it more valuable or less valuable by looking at some T charts. So the first thing I want you to understand is how much does my option move if the underlying stock moves by $1, right? So you own an option, whether that's a call or a put, whether you are long the call or short the call, long the put or short the put, it doesn't matter what option you own. One of the first things you want to understand is how much is the option going to change by if the underlying stock moves by $1. And that's exactly what delta tells us. So we're going to go over 4 Greeks today. The first one we're going to look at is delta, arguably the most important Greek of all of them. Delta is the theoretical estimate of how much of an option's value may change given a $1 move up or down in the underlying security. What that means is that if you have a call option with, if you have a call option with a delta of 0.3, that means if the stock moves up by $1, the option value will move up by 30 cents. On the other hand, if let's say you have a call option with a delta of 0.6, so that means for that same $1 move in the underlying stock, this second option that has a delta of 0.6 will move up by twice as much, by 60 cents. So when you're thinking about your choices for options, when you think about buying an option, let's say you believe the stock is going to move higher and you're thinking about buying a call option, well, that's when you want to look at what is the delta of the option, because that's going to tell you how sensitive that option is going to be to the underlying security moving in the direction that you expect it to. That's one of the key reasons of why we look at the Greeks, to help us understand the sensitivity of an option to the underlying security. Now, when we look at deltas, this is going to range between -1 and +1, depending on calls or puts. Calls will range from 0 to 1, and puts will range from 0 to -1, because calls move up when the underlying moves up, and puts move down when the underlying moves down, right? So puts have an inverse relationship to the underlying security. Calls have a positive relationship to the underlying security. And when we think about delta, the best thing to think about it is that a long call, when the stock moves up, a long call becomes more valuable. When a long put, it becomes less valuable. And deltas will simply move closer to 1 as the stock moves higher, and long puts, the delta will move closer to 0 as the stock moves higher. So the higher the delta, or rather the greater the absolute value of the delta, the more beneficial it is going to be your long option. And bullish strategies will profit from deltas moving closer to 1, and bearish strategies will profit as delta moves closer to -1, because the higher the relationship is closer to 1 is better for calls, and the lower the relationship is -1, the better it is for puts. So you can trade when you're selecting an option, you have a choice of choosing deltas that are between 0 and 1 for calls, and between 0 and -1 for puts. And depending on which one you choose, they're going to have different prices. But depending on which delta you choose, that's how you're going to determine what exposure you have to the underlying security using the call. So let's use Shopify, for example, here. And in this particular example, at the time, Shopify was trading at $31.73. And what we have are different options that you can purchase, right? As you can see, you have an options chain with lots of different strike prices ranging from, below 19 all the way through, above 38. So what we're going to look at is 3 different options. We're going to look at a deep in the money option here. A deep in the money option here, which is an option that has a 19.5 strike option. So this is something that's deep in the money, so because the stock's trading at 31, a $19.5 strike is deep in the money. And as you can see, the delta on this specific options contract is 0.958. and it has a price of $12.43. So basically what you have is a 30-day option that is deep in the money, and it has a delta of 0.95. And what that means is that for every $1 Shopify moves up by, this option will move up by 95 cents. So that's very close to dollar for dollar, right? So for every $1 the stock moves up, the option will move up by 95 cents, nearly dollar for dollar. And here in this particular example, you're paying $12.43 for that call contract. So think about a stock, right? If you bought 100 shares of the stock, it would move exactly dollar for dollar. But if you were to buy 100 shares of the stock, you'd have to pay $31.73 per share. Here with the call option, you're paying $12.43, roughly 1/3 of the price of 100 shares of the stock, yet you're getting a very similar exposure to owning the stock. And that's what a deep in the money option is going to provide you with, is very similar to being a leveraged stock position, right? Because you're paying a fraction of the price to buy this to buy the stock, yet you're getting exposure that's very similar to being long the stock. That's the way to think about a deep in the money option. So anything with a delta that's, let's say, 0.9 or 0.95, anything like this, delta that's 0.94, 0.95, 0.96, these types of options basically are like a leverage stock position. Okay. Versus if, let's say, you took a call option that was at the money, right? A $32 call option. This is an option that's basically at the money because the current stock is trading at 31.73. As you can see, that has a delta of 0.54, and it costs you only $2.91. So here your trade, costs you a little less than 10% of the stock's value. And what you're going to get here is a delta of only 0.54. So for every $1 the stock moves up by, you're going to see the value of your option increase by 54 cents. So half the exposure that you get with the deep in the money option at a price that's only about, in this particular case, less than 10% of the stock's value. And lastly, if you choose an out of the money option, if you choose an out of the money option here, a $37 call option, that has a delta of only 0.29 with a price of $1.18. So as you can see, this now costs you less than 5% of the stock's value. But it only provides you with a 0.29 delta. So for every $1 the stock moves up by, you're only going to see the value of your option move up by 29 cents. So what you see here is that delta tells you how much exposure you get to the underlying security, and you get to choose, depending on how much you can afford to pay, how much you're willing to risk, to determine how much exposure you can get to the underlying security. The more you pay, the more exposure you get to the underlying security. And a lot of people ask me, what's best, right? And the reality is that there's no best option. The question is just how much exposure do you want, and how much are you willing to pay for that? And you generally try to find a balance between the amount of exposure you're looking for versus how much you're willing to risk on the overall trade. So the delta just gives you that understanding of the different choices and how different the choices are. Okay, so delta, how is it used? It gives you, it allows you to assess the directional risk, right? How much risk you actually have. Bullish strategies have positive delta, bearish strategies have negative delta. It can also tell you how much sensitivity you have when you're looking at a combination of securities or a combination of positions that you have in your overall portfolio. So let's say you own 100 shares of XYZ stock. That has a delta of 0.1, right? Because a stock gives you dollar for dollar exposure. And then let's say you're short a XYZ call with a delta of negative 0.3 because you're short the call option. So that's why you have a negative delta. Well, you can add these two together, and what you can see, your net delta is 0.7. So what that means is that if you own 100 shares in the stock, and then you're also short a call option that has a delta of 30, then your net delta is going to be 0.7, right? So when stock XYZ moves up by $1, your portfolio will gain by 70 cents. That is how you can always use deltas, because you can just simply add deltas up across all the different positions you have in that specific security. And the net delta you have will give you an idea of the sensitivity you have to that underlying security. So even if you have 4 different option contracts on stock XYZ, you can simply add up the deltas, and that will give you an idea of how much exposure you have to that underlying security as it moves higher and lower. The other way that you can think about using deltas is when you're using multi-leg strategies. So in this particular example, if you have both a long call and a long put in an underlying XYZ, the long call has a delta of 0.55. The long put has a delta of 0.45. Your net delta on this is 0.1. So for every $1 the stock moves up by, you will see a 10-cent increase in the underlying options position that you have. And then lastly, the other thing that you can do with deltas aside from assessing how much traction you have to the underlying security, is assessing the probability of being in the money at expiration. So let me go back to the options chains to show you this. So when we think about deltas, right, delta not only tells us the sensitivity of the option to the underlying security, but it also gives us an approximation of the probability that the stock will be above the strike price at expiration. So what do I mean by that? When I look at, let's say, the 24 strike, it has a delta of 0.88. What that means is that there's an 88% chance that by the expiration date of this option, there's going to be an 88% chance that the stock will be above $24 at expiration. Vice versa, if let's say I look at the 35 strike, as you can see, it has a delta of 0.38. What that's telling me is that by the expiration date, there's a 38% chance the stock is going to be above $35 at expiration. This is incredibly useful in terms of helping you select strike prices, because when you take a probability-based approach to selecting your strike prices, you're going to get a much more consistent result, especially with strategies like income strategies. Let's say you're selling cover calls or you're selling cash secured puts, right? If let's say you use a delta based approach to select your cover calls, meaning every single time you look at selling a cover call, you always find the strike price that is closest to 0.25 deltas, in this particular case, a $38 strike price, then what you're going to basically do is that if you always use a probability-based approach, then you're going to have a much more consistent income stream from your strategy. Because if I constantly select 25 deltas to sell, then I know 75% of the time, I'm going to keep the income on my cover call, and 25% of the time, I'm going to have that stock get called away. And I have a much more consistent income stream from selling cover calls than if I was just selecting strike prices based on, let's say, technical levels or based on income levels. You know, a lot of times people will select cover calls based on how much income they can potentially generate or how much premium they can generate. But that will generate inconsistent results over the long run, because if you're just constantly trying to seek a specific dollar amount, you're not going to see the same type of probabilities each time. So that's why deltas is an incredibly important Greek to understand, not only from an exposure perspective, but actually, in my opinion, more importantly, from a probability-based perspective, is really useful in helping you select your strike prices. So that's kind of where delta, can be utilized in your portfolio for trading options. Next, what we're going to cover is theta, right? So we just went over delta. Basically, for long calls and long puts, delta is positive, and then short calls and long puts. Long calls and short puts, you have positive delta. Short calls and long puts, you have negative deltas. So the next thing, let's take a look that I think is important for us to learn is how much does my option lose each day as it approaches expiration. So we talked about the fact that the extrinsic value part of your option has two components, time value and implied volatility. So right now we're going to talk about the time component of it. How much time is left between now and expiration, and how does that affect the value of your option? Because that is what the Greek theta tells us. Theta represents, in theory, how much an option's premium may decay each day with all other factors remaining the same. So if you own call XYZ call and you see that it has a theta of 0.03, that means for every 1 day that goes by, that option is going to lose 30 cents in value. On the other hand, if you have another call option at a different strike price where the theta is 0.6, that means for every 1 day you own that option, the value of that option is going to decay by 60 cents. So theta is always measured in dollar value. So whatever the theta you see, the theta value you see on your options chain, that's going to tell you in dollar terms how much money you're going to see the value of that option decay for each day you hold on to that option. So the more time passes, meaning the less time there is left between now and expiration, the less valuable a long call and a long put is going to be. And the theta is not a static number. Theta actually increases in value as you get closer and closer to expiration. So for example, in this example here before, if let's say today's theta is 0.3, by tomorrow, that theta could increase to 0.31, and the day after it can increase to 0.32. So as each day goes by, not only are you losing money, but each day losing money is not the right term. Not only for each day that passes does the value of your option decay, but as it approaches expiration, that decay actually accelerates and gets faster and faster. So depending on whether you're long or short the option, that's either working in your favor or against you. But it's important to understand that theta is not a static number. It's not like if you own this option, you're just going to lose 30 cents every single day you hold on to it. You're going to lose 30 cents today. You might lose 31 cents tomorrow, 32 cents the day after. And the longer you hold on to it, the more it will decay for each day that you own it. So this is something that's important to understand that works against someone who owns an option, but actually works in your favor if you are short the option. So going in the same example that we're using before, when we're looking at Shopify here, that deep in the money option has, as you can see, a very low theta, because when we have a deep in the money option, the extrinsic value of the option is very, very low relative to the entire value of the option. So only 20 cents of the $12.43 is extrinsic value. So there's very little that can even decay away, which is why you have a theta of 0.01. So for each day you hold on to it, you're losing roughly $1 in value, right? I'm sorry, 1 cent in value. So $12.43, you're going to lose 1 cent of that value for each day that you hold on to it. Versus if you look at an at-the-money option that has a price of $2.91, an at-the-money option, the entire value of the option is extrinsic value. So in this particular case, you have a theta of 0.04. So an option value of $2.91, it's going to lose 4 cents in value today that you hold on to it. Tomorrow, you're going to lose potentially another 4 cents. And then as time goes by, that's going to tick higher. Maybe by, let's say, day 10, you're losing 5 cents a day or 6 cents a day. So theta is going to increase as it gets closer and closer to expiration. Not only is it working against you as an option buyer, it's going to increase in value. So what you have to look at is not just the value of theta, but also what percentage of the value of the options value you're losing to each day. Because as you can see here, when you go out of the money option, it looks like theta is actually getting smaller here, right? So that $37 call option, as you can see, the theta is only 0.03. Which looks like you have a smaller theta, but you have to remember the value of your option is also much, much smaller. So yes, you're only losing 3 cents a day versus 4 cents a day, but 3 cents a day is a larger percentage of the $1.18 that you paid for that call option than 4 cents out of the $2.94. So out of the money options are actually decaying faster as an overall percentage of the value of your option than an at the money option, which theoretically has the highest theta. So those are some of the things to consider when you're thinking about an option, because this is going to affect you on both sides, whether you're owning the option or you've sold the option. If you own the option, it's working against you, which is something you always have to think about, whether it's still worth owning that option because it keeps decaying in value, and vice versa. If you're short the option, that time decay is going to be something you want to capture as fast as possible, because you obviously want the value of your option to decay as close to zero as possible by the expiration date. And theta helps you understand how fast that decay is actually happening at. So theta, it helps you assess the extrinsic value exposure that you have and how much it's going to decay. Long options have negative theta, short options have positive theta. So it's just a matter of whether theta is working in your favor or against you. And then just like in the example before of delta, with all of the Greeks, you can simply add up the thetas of all the legs that you own in an underlying security, and that's going to help you understand the net decay that you have on the overall position. So if, let's say, you have a bull call spread where you're both long the call and short a call at different strike prices, you can basically add up the thetas that you have across both legs, and that's going to tell you how much theta you actually have. In this particular case, if you have a net theta of negative 0.01, what that means is that for each day you hold on to this bull call spread, you're actually going to gain 1 cent in value each day. So negative theta, sorry, hold on. Let me make sure that we're looking at this the right way. Yeah. So, the long call is losing 5 cents per day, and the short call is gaining 4 cents a day. I apologize. That should be positive 0.1, not negative 0.1. So because you're losing 5 cents a day on the long call and you're gaining 4 cents a day on the short call, your net is that you're losing $1 for each day that you hold on to this trade. So you can basically add up the thetas across your different legs that you own, and that's going to help you understand how much decay that you have across an entire position, not just on an individual leg basis. And then in a different example here where you have a bull put spread, let's say you're long a put and that has a theta of 0.06, and then you have a short put where you have a theta of 0.08, then what you're basically is you're losing 6 cents a day on your long put, but you're gaining 8 cents a day on your short put. Your net theta on this is going to be 0.02. So you're going to gain 2 cents per day as you hold on to this bull put spread. So you simply add up all the thetas across the legs, and that's going to help you determine your net exposure for the position that you have. So that covers theta, right? So basically anything that's long calls and long puts is going to have a negative effect for theta. Short puts and short calls are going to have a positive effect from theta on those overall positions. Now, this is the part, no, actually, let's take a pause here, right? We've covered delta and we've covered theta. Arguably, those are the two that are most important for your trading. Meaning, if this is the first time you've learned option Greeks and you're just kind of getting started with understanding option Greeks, I would take the time to kind of review delta and theta and make sure you truly understand those two, because those are the two that actually has the most exposure to your underlying position. Those are the two things that's going to affect the value of your option the most, more so than anything else we're going to cover here today. The other two Greeks that we're going to cover here today, while important, they have a smaller component to the changes in the value of your option. So if you find the stuff overwhelming, if you find the stuff complex, that's okay. I would say take the time to just focus on delta and theta, understand that first before you even attempt to learn the next two that we're going to go over. Okay. And once you feel that you've got a grasp on delta and theta, then you can move on to gamma and vega, which we're going to cover next, which, like I said, is important, but they're going to have a much smaller effect on the value of your option than delta and theta. So make sure that you understand delta and theta before you move on, because those are the two most important Greeks for trading options. So now that we've covered delta and theta, the thing to understand with all of these Greeks is that none of them are static, right? So if you have a delta of 0.5, it's not like it's just going to stay at 0.5. Delta is going to change as the underlying security changes. So the question is, how much does delta change when the underlying changes? And that's what gamma tells us, right? Meaning delta is not a static number. It's going to change. And gamma tells us how much delta is going to change by. So gamma represents the rate of change between an option's delta and the underlying asset's price. So if you have stock XYZ, and you have a call option that has a gamma of 0.2, what that means is that for every $1 that the stock moves up by, your delta is going to increase by 0.2, right? So delta tells us the sensitivity we have to the underlying security. Well, as the stock moves up, let's say currently you have a delta of 0.5, right? And the stock moves up by $1. Once it moves up by $1, you're no longer going to still have a delta of 0.5. You're now actually going to have a delta of 0.7. So what that means is that if it moves up by $1, let's say you make roughly 50 cents on that $1 move, the next dollar it moves up by, you're not going to make 50 cents, you're going to make 70 cents because delta has changed, right? Same thing. If let's say you have another option with the delta of the gamma of 0.08, what that means is that for every $1 the stock moves up by, the delta is going to move up by 0.08, right? So if you start at 50 cents and the stock moves up, if you have a delta of 0.5, and the stock moves up by $1, now you have a delta of 0.58. And then if it moves up by another dollar, then it'll go up to, let's say, 0.66, right? So delta is not static. It changes as the stock moves higher or lower. And gamma tells you how much the delta is going to change by. So, for those of you that have studied calculus, gamma is basically a second order derivative. Delta is the first order derivative. Gamma is the second order derivative. If you have no idea what I'm talking about, that's okay. It's not really that important. So if the stock moves up, long calls get more valuable, long puts get less valuable, and deltas will have a positive impact and deltas will have a negative impact for long puts. So, gamma is really the reason that a lot of people trade options, right? People trade options because you have limited risk with potentially unlimited profit potential, right? That's what a long call is, right? And same thing with a long put. You have limited risk with substantial profit potential on a long put. So how do you actually get that asymmetrical risk, right? How do you actually have something that gives you limited risk, but leverage if you are correct, and limited risk to the downside if you're wrong? It's really gamma that actually facilitates that, because gamma will make delta higher and higher as the trade goes in the direction you expect it to, and it'll actually decrease delta to zero as the trade goes against you. So gamma is an important component to understand, because it is what provides the convexity of an option contract that gives you kind of that asymmetrical risk reward ratio that we all seek when we're trading options. So if we look at kind of the gamma portion of an options chain, right? So we go back to our deep in the money option, that $19.50 strike price on Shopify. That 30-day call option has a gamma of 0.091, right? So that's a very, very low gamma. So for every $1 the stock moves up by, delta is only going to move up by 0.0091. Because because the delta is already approaching 1, right? Even if the stock keeps moving higher, delta can't really move up by much more because it can't be greater than 1, right? It's already at 0.95. That's why gamma is so low for deep in the money options. So it doesn't really matter a whole lot whether if the stock moves higher or lower for those deep in the money options, you're going to get a very high exposure and it's not going to change by much because gamma is very low. Vice versa, if you have an at the money option, let's say we use that $32 call option, it has a much higher gamma. It has a gamma of 0.05, right? So for every $1 the stock moves up by, the delta is going to increase. The delta in this particular case was 0.53, right? So in the $32 strike, it has a delta of 0.53. So now if the stock moves up from 32 to 33, it's not going to stay at 0.53. It's going to increase by 0.05. So it'll go from 0.53 to 0.58, right? So I'm going to get more exposure if the stock moves in the direction I expect it to. So if the next dollar goes up by, instead of moving up by 53 cents, it's going to move up by 58 cents. And then after that, it's going to move up by another, as you can see, the gamma on the next strike is also 0.05. So it goes from 0.58 to 0.63, right? So for every dollar goes up by, delta is going to keep increasing, and that's what gamma tells us. And lastly, if I use that $37 call option, it has a gamma of 0.04, right? So if it goes from 37, where it currently has a delta of 0.29, right? If it goes from 37 to 38, that delta is not going to stay static at 29. It's going to go up to 0.33, right? So that's how you can think about gamma in terms of, you can think of gamma as like the accelerator and the brake, right? As it goes in your favor, it kind of presses the accelerator down and gives you more and more leverage. And then as the trade goes against you, it's the brake and it kind of decreases the amount of leverage that you have in the underlying security or in the option that you have. So that's kind of another way to think about gamma. So how is it used? It assesses overall your sensitivity to the underlying. So it really is a component of delta, right? So when you think about gamma, you're really thinking about sensitivity of the option to the underlying. But it's just that gamma is a second order derivative or a component of the delta exposure that you have in the underlying security. The delta is the important part, but delta changes. Delta is not static, and gamma tells you how much delta is going to change by. And just like the other Greeks, you can always add up the gammas across your multiple legs, and you get the net gamma. So for example, if you have a bull call spread with a net gamma of 0.02, that means as the strategy moves $1 in the direction that you expect it to, the absolute value of the delta will increase by 0.02. So we've covered three of the four Greeks, right? So gamma is always going to work in your favor when you're long the option. So long calls and long puts have positive gamma, short puts and short calls have negative gamma. And lastly, we're going to cover Vega. So we talked about extrinsic value has two components, time value and implied volatility. So this is really where how much does volatility affect my option, specifically implied volatility? How much does the market expect future volatility to look like? How is that going to affect the value of my option? So Vega measures the amount of increase or decrease in an options premium based on a 1 percentage point change in implied volatility. So, for example, if you have XYZ call with the Vega of 0.17, that means if implied volatility option moves up by 1%, you will see the option premium increase by 17 cents. Vice versa, if it has a Vega of 0.1, that means for every 1% change in implied volatility, the value of your option will increase by 10 cents. So basically, as the market expects volatility to change, it's going to change the value of your option. So, for example, let's say, let's think about like the type of things that will generally change implied volatility. So, as you get closer and closer to an earnings event, implied volatility will generally rise going into the event because as you get closer to the event, the more uncertainty there's going to be around the event, right? Um, because an earnings event can potentially cause a lot of volatility. So as you approach that earnings expiration or earnings event, the expectation for volatility increases, right? The probability of the stock making a big move in a short amount of time increases when there's something like a product announcement, when there's earnings coming up, when there's any type of news event that comes out that adds uncertainty to the future value of a stock. That is what's going to increase implied volatility. Vice versa, if a news event just came out, right? Let's say Apple just released earnings. Now the uncertainty is over, right? It's out in the air, it's out there. That's when implied volatility will decrease because now there's a far lower chance of some uncertain thing happening in the near future because you just had a lot of information that's been released and that information has now been digested by the markets and now that uncertainty is gone, right? So those are the types of things that generally will increase or decrease implied volatility and is important to think about when you're thinking about the value of an option. But remember, as we look at the options chain, you're going to realize that Vega is generally speaking something that has a relatively smaller component or smaller impact on the value of your option versus, let's say, delta or theta. So, for example, let's look at that our deep in the money option here again. That is a Vega of 0.008. So that means for every 1% change in implied volatility, you're looking at less than 1 penny of a change in the value of your option. So very, very small impact on the value of your option, almost negligible, right? Versus if you look at the at the money option, you have the Vega of 0.03. So you have an option that's currently priced at $2.91. If implied volatility moves up by 1%, you're seeing the value of your option change by roughly 4 cents, right? So still in this particular case, you're talking about less than 2% change in the value of your option for a 1% change in implied volatility. A relatively small exposure. It's not negligible, it's not nothing, but it's a pretty small component of the changes in the value of your option. And lastly, if we look at your out of the money option has a Vega of 0.03, so basically 3 cents worth of exposure for every 1% change in implied volatility on an option that's worth $1.18, that's a larger percentage now, right? So, but we're still talking about 3-4% of the options value will change for every 1% change in implied volatility. So not negligible, but not a huge component to the value of your option versus, if you look at delta of your out of the money option, your delta here is 0.29, right? So for every $1, of the stock's value changes, you're influencing 29 cents of your $1.18. So a much, much larger component of your position is exposed to delta, is exposed to theta versus to Vega, because Vega doesn't change a whole lot from day to day, right? Versus theta, every single day you're eating away. In this particular case, 3% roughly of the stock's value of the options value every single day you hold on to it, and for every $1 change, you're influencing roughly 29 cents. Delta and theta have a much larger impact, and those are the two that you really need to focus on for trading. And then as you get a little bit more comfortable and you understand delta and theta much better, that's really when you can start taking a look at gamma and Vega. But those two have still a much smaller component to the changes in the value of your option. So, looking at Vega, how is it used? It assesses volatility exposure. Changes in expected future volatility will change the value of your option. Long options have positive Vega, short options have negative Vega. And just like all the other Greeks, you can simply add up the net Vegas of your overall position. And so, for example, in this bull call spread, you have a net Vega of 0.07. That means for every 1% change in implied volatility, you will see the value of your option increase by 7 cents or $7 for the full contract. And with that, that kind of wraps up the four Greeks that we referred to, that we learned here today: delta, theta, gamma, vega. Like I said, delta and theta are by far the two most important for your trading. So with that, that covers what I wanted to share with you here today with regards to the option Greeks. We did go through that fairly quickly because it is a lot of information to digest. It is a lot of information to understand. But like I said, if you're learning this for the first time, focus on delta and theta. If you have a little bit more experience, or if you feel that you've got a full grasp of delta and theta, then you kind of look into gamma and vega a little bit to help you better understand the full impact to the value of your options based on different factors in the overall markets. So with that, what I'll do is I'll open this up for Q&A. If you have any questions, feel free to type your questions in the Q&A window. I'll try to answer as many questions as I have time for here in the few minutes that I have left, and I will try to get as many questions. Christian's asking a question. He's saying, "Hi, thanks for the great seminar. Is it valid to assume that at-the-money options are better if the price is relatively stale while the earnings are projected to be extremely good?" I'm not sure I understand that question, Christian. I'm not sure what you mean by the price is relatively stale, and what do you mean by earnings are projected to be extremely good? I think that if you think that if you think of that an option is going that and earnings are projected to be extremely good, then generally what you want to do is maybe something like an out of the money option, right? Because what that means is that the change in the underlying security. So let's say you buy something for $1.18 and you think that stock's going to do really well on earnings, right? You want something that has a high delta to price ratio, right? So here I'm earning 29 cents for every $1 the stock goes up, and I'm only spending $1.18 for it, right? That's a very high ratio. So if the stock goes up by even a couple of bucks, I'm going to make a nice size return, right? Versus if, let's say, I pay the $12.43 for a deep in the money option that has a delta of 0.95. So if the stock moves up by a couple of bucks, my net return on the trade is only going to be maybe 20-30%, right? Because the stock moves up by $2, I'm going to make roughly $2 on the stock, but I've paid $12 for the exposure, so my net return is going to be much lower. So if you think the stock's going to make a big move on earnings, you generally want to maybe trade something that's further out of the money, because the amount of money you can potentially make relative to how much you've paid to get exposure to it is relatively high. You want to have that ratio as high as possible, if that makes sense. Where can you find the Greeks? Great question. So you can do it on the Options Play platform within your First Trade platform. You can find Options Play by clicking on the Option Wizard screen when you go to your home screen at Options at First. Also, if I'm not mistaken, you can now find the Greeks on the mobile platform for First Trade as well. Joe, you're very welcome. I'm glad this was helpful. How to use the option to play the earnings, especially benefit on the volatility increase and then decrease. Um, so you know, you the Vega is still going to be a relatively small component, even though it has some influence on the value of your option around earnings. I certainly wouldn't trade an option just on Vega alone because you have far more exposure to Delta than you do to Vega. So I would focus on the Delta component and less so on the Vega component. The Vega just tells you, you know, additionally how much exposure you have to changes in implied volatility, but it's not the major component. It's not going to make or break your trade. Delta is going to, on their hand, make or break your trade. Yes, this session is recorded, and you'll be able to watch this after the fact. So delta is always going to be $1 change in the underlying security, right? So for um, a high price stock, you're going to have $1, as you say, it's just fluctuation. But that also means that for a high price stock, you're going to pay a lot more for the value of that option. So it's already adjusted for based on the price of the option. How do you suggest to use the hourly updated credit spread report and first trade effectively? Um, well, the credit spread report is designed to help you find optimal credit spreads, right? Credit spreads that collect at least one third of the vertical width, that aligns with the technical view of the underlying security, and is very liquid. Basically, what I do is I basically look at that list. I sort it based on what percentage of the width that I'm collecting in terms of premium, and I'm looking at the top ones. I look at a chart. I make sure I agree with the underlying chart. Maybe you want to look at the fundamentals as well to see if you agree with the fundamental thesis. But everything else has already been done for you. You don't have to do a lot more research than what's already put out for you by the credit spread report. The whole point of that report is that it does all of the work that's required to find an optimal credit spread to sell. I myself have not written a book. What books do you recommend? The Options Playbook is a really good beginner book for option strategies by Brian Overby. You can find it on Amazon. It's called The Options Playbook. So for volatility itself, is it better to buy or sell options and when? So, I mean, the thing is that the most reliable change in implied volatility is right after an earnings event, right? So it goes from high to low. That is a pretty much guaranteed change in implied volatility. If you hold an option prior to earnings to right after earnings, that's going to be the most reliable change in volatility. So you do have a fair amount of exposure there. But like I said, you have far more exposure to delta, right? So just trading the volatility itself, not a great, not a great trade because you're also going to have a lot of delta exposure in addition to that, meaning even if you were able to nail the implied volatility component to it, you might lose far more than that on the delta component to that, which is why you don't trade just Vega. You can just trade Vega, but you generally don't unless you have a more professional setup where you have actual volatility forecasts and you have a view on volatility, which is not what we're covering during today's session. I would say it's really difficult to anticipate what IB will change on a stock option. Um, there are professional traders that model volatility and try to forecast volatility, and that's a whole different ballgame than what we have capacity to discuss during today's session. Today's session is really to give you an understanding of what exposure you have to volatility. Does that mean that if I expect the stock to go up fast, I can choose to do an out of the money option? On the other hand, if I expect the stock to go up slowly, it's better to do an in the money option. As a general rule of thumb, yes. Because if you expect something to go very slowly, you want something with a very low theta, something with very little time decay, right? And that's what an in the money option provides you with. If you expect something to move very fast, you're not too worried about time decay because you think that it's going to move in just a very short amount of time. You want to get as much bang for your buck on that, and out of the money option is suitable for that. So, great question, and you're absolutely right from what you've learned. Are the options play and options wizard the same place? Yes, it's the same platform, and First Trade just chooses to call it the options wizard. Why do people recommend a delta of 0.3? I don't know that people recommend it. First, I think you have to specify what strategy we're talking about, right? Certain strategies that I would say that people recommend a delta of 0.3. A lot of times, option selling strategies like a cover call or cash secured put. I've heard people will, gravitate towards a 0.3 delta as a starting point. We've done a lot of research on this for different strategies, and we have different recommendations for different types of strategies. I don't think you ever want to have, a generic use a 0.3 delta for all strategies. That certainly is not, from our research, very optimal. When will you be doing regular seminars on options? We do it every single every other Wednesday, right? So I'll be back next in 2 weeks' time at 12 p.m. doing these sessions. What is a good combination of the four Greeks in order to choose the option? I'm not sure I understand that question. Each Greek is separate. We don't think of them as a combination. Would it be useful to consider the ratio of gamma to delta or gamma as a percentage of delta? You can. All of these you can think of them as ratios, right? And it just depends on what your views are to determine whether a higher ratio is better for you or a lower ratio is better for you. And that really depends on whether you're long or short, right? If you're long, you want a high ratio. If you're short, you want a lower ratio. Calculate your ratios and then figure out what's better for you based on your positioning. So the ratios are an important thing, in my opinion, to think about when you understand these Greeks. The author of the options playbook is Brian Overby. Would it be a good strategy just to sell out of the money on high volatility times? That's generally accepted best practice, right? But I would say that's very generic. I think that it's hard to offer kind of that kind of overarching statement all the time. I think there are a few other components to consider, but as a general rule of thumb, selling out of the money options in high volatility environments is a generally accepted best practice. With that covers what I have time for here today. We've gone slightly over an hour here, but this is an incredibly engaging topic, in my opinion. This is a very important topic. I hope that you guys found this valuable. We did go over a lot of things in a short amount of time. So if this is the first time you're learning about the option Greeks, I'm sure you have found some aspects of this perhaps confusing or overwhelming. Take the time to review the recording. This is not something you necessarily pick up the first time you learn. It takes a little bit of time for this stuff to sink in, but once it does, it's going to make a lot more sense and it's going to really help you with your options trading. So with that, thank you so much for those of you that did join me here today. I will be back here in 2 weeks' time. We're going to switch things up. We're not just going to do these types of things every single time, but we do try to cover all of the basics, make sure you have a well-rounded education with regards to options trading. So I look forward to seeing you guys here in 2 weeks' time. Otherwise, I will see you guys on Tuesday mornings for our market outlook session. Thank you so much and have a great trading day.